So I bought a value add seniors housing property last year with a 70% loan to value loan from a FinCo. It had a 1 year term and two 6 month extensions. And my plan worked out great, just as I planned. The community is now stabilized, producing meaningful cash flow. The value of the property also exceeds the price I paid by about 50%. So I just hit it out of the park. What can I say? And now I want to take some cash out and do it all over again with another opportunity. So, what do I have to do to maximize my cash out in this situation? And can I maximize my cash out in this market today? Or should I just sell at a big profit and then start again that way?
So let me take the first part of that, Ben, and I would say the decision to sell needs to be a reflection of your long-term plan for the asset, the location, the concentration of your holdings as it relates to this particular asset. Do you want to be in Buckhead? Do you want to be in Scranton? That should have an overriding impact on whether or not you sell. If it's a non-core asset and you make the money, that's a much easier answer than it's one of your core holdings and you happen to profit very well. So I'd lead with that. As it relates to, how do you pull as much cash out? I will defer to my two partners on this call, but I would say, generally speaking, most lenders do not like cash out scenarios. I haven't seen very many cash out scenarios with Freddie Mac. I have seen some. Fannie Mae appears to be entering back into the marketplace, which I think is very good for our industry to have two competitors, two contemporaries. And I think that may bolster the opportunity to get cash out on a long-term agency financing. But generally speaking, most lenders want to see skin in the game, and they want to limit cash out scenarios. So I would put at the top of the sort of decision tree. Do you want to be in that market? What does that asset represent to you in terms of your long-term investment structure in the marketplace, relevance, all of those things, and then secondarily, understanding the cash out proceeds. You're sort of in the exact opposite of what a lender wants to do. But again, I would lead by saying you need as much time as possible. This stuff you ought to be thinking about this stuff a year out.
Yeah, I would add tax, as a big part of the consideration as well to that. Selling and taking a capital gain is very different than extracting equity from a refi, and holding the property, benefiting from interest and depreciation, tax shields. So I think that's another component to that. But I agree completely with Matthew. Like, your goals, you need to be crystal clear on your goals, your portfolio, your plan, because that'll help drive a lot of meaningful decisions. I also echo that cash outs, not quite a four-letter word right now, but it's close. So that does point us a little bit towards HUD. HUD is more of a programmatic lender. It's, you need to bridge to take equity out with HUD. So there are some steps involved with that. But that's a pretty common, process that can be done. And because it's more of a formulaic underwriting process, it's a little bit more predictable. Whereas a Fannie Freddie are a little more subjective, right? The lenders and the agencies themselves are a little more subjective around that. So I do think that if you wanted to maximize cash out, a HUD execution today is probably your best bet, unless you wanted some, fairly expensive, debt fund or private sourced capital, FinCo capital. The other challenge is, we can't really say that today's a great sales market. I mean, deals are trading. There's a lot of transaction volume, but those are not, sort of max value transactions. Investors are still very cautious, and so, I guess, not knowing all of your fact patterns, a recap and hold for a home run asset to me seems like it feels like the right thing to do. And then you have the discretion to clip coupons a little bit in the interim, and then sell in, if or when we come to a sort of, make an offer I can't refuse environment.
Mhm.
Again, if it's not non-core, to Matthew's point, non-core, not a market you want to be in, like, then a sale today could be a great way to just pull the maximum amount of dollars out of this asset, and use that to redeploy for your next property or several.
Yeah, I want to know who this operator is. I'd like to back them. 50% value creation in less than a year.
It might not be too late, Zach. We might be able to buy in after this call.
That's right. We'll make Ben an offer he can't refuse.
There you go.
I want to
yeah.
bring my secret sauce to other opportunities. What can I say? But
like
go on, Zach.
Implicit in the question or the fact pattern, like outside of the tax treatment of refinancing versus selling, like I guess Nick, you kind of touched on this, but like, is the sale market today more robust than the financing market? Is the financing market more robust?
Yeah, I think you're right, Zach. And I think it goes back to what we were talking about in the first scenario, right? Timing and creativity, right? There's a bunch of different options. You could sell, you could refinance. HUD is a fantastic option. Again, with Fannie and Freddie appearing to be more and more contemporaries of one another, Fannie getting back up to speed, there's a potential for a cash out situation there. You need some creativity. You need to understand the market dynamics, what cap rates are doing. Nick, I agree with you that right now, I can't tell you whether the 10-year is going to continue to go up forever or whether it's going to come back down, but we know that 10-year has a pretty significant influence on where cap rates are. So if the value of your property 6 months ago when the 10-year was at 373, I would argue is higher than it is right now at a 424. Right? All of those things have to be considered. You need some time to contemplate.